TRAB should only entertain objection decision. So the matter then went from the TRAB to the Court of Appeal, where now we have the famous Pan-African Energy cases, that is appeal number 121 of 2018 and appeal 172 of 2020, where the Court of Appeal then established that waiver decisions are not appealable, meaning that the board should only entertain objection decisions, should only entertain appeals that are emanating from objection decisions. Sorry. But recently, there has been a new finding, or there has been a new authority. It's a bit different, not exactly the same as waiver rejection decision, but it's more of what happens when TRA is administratively inactive. That is, they do not discharge their obligation within the prescribed timelines. For instance, you had applied for a waiver. TRA was supposed to reply to your waiver within the prescribed timeline, that is within 30 days after the receipt of the assessment, but they have not done that. They have not done that. Then are you still able to appeal against that inaction? So now the recent ruling in Wilbert Bacillus Kapinga vis-a-vis Commissioner General via appeal number 145 of 2022, the Court of Appeal held that the board has now jurisdiction to entertain non-objection decisions that are merely emanating from the TRA administrative inactions, or in a simple nutshell, that is omission. So now, with this ruling, it will be very interesting to see how practically will be moving, especially given, for instance, for quite some time, we have seen that TRA has been taught in the tax administration law that, for instance, they should be determining income tax refund within 90 days, but they have never done that. Or the recent amendment that VAT refunds should be determined within 30 days. Now, with this ruling, it means now taxpayers can even go and challenge TRA in case of the administrative inaction to deliberate, let's say, those refund within the prescribed timeline. So it's a welcoming decision to taxpayers, as it is now going, as now taxpayers will have a room to hold the Tax Revenue Authority accountable. Okay, sorry guys, I was having some health challenges, so bear with me. Yeah, so moving on, I think most of us, we are also aware of the concept of branch and parent office, where, let's say, a parent office secures a contractual arrangement to deliver or to provide certain services in a country. And as a matter of delivering or executing that contract, they normally establish a a registered branch in the country to assist with the execution of that contract. Now, that arrangement normally gives rise to what we call onshore and offshore revenue concept, where, for instance, you might find that the way the contractual arrangement is structured, let's say the parent office will just manufacture, design, and deliver, let's say, certain equipment, and where now the registered branch in the country will just go and install the delivered equipment. So from that arrangement, the income that is earned by the parent office is what we call offshore revenue, while the income that is earned by the registered branch in the country is what we call onshore revenue. Now, there has always been a provision, that is Section 92, subsection 5 of the Income Tax Act, revised edition 2023, which intend to tax a permanent establishment of a registered branch in the country, whereas it tends to reallocate offshore revenue earned by the parent office in case the activities that are done by the parent office with the local are similar or same to the activities that are done by the registered branch. In other words, is if one is to look at the activities that are done by the parent office and the activities that are done by the registered branch, if there is an interdependence, then Section 92, subsection 5 give the taxman the power to reallocate offshore revenue to registered branch. And what is the rationale for that? That is because Section 92, subsection 5 is what we call an anti-tax avoidance provision. So it's a provision that has been construed for the mere reason of ensuring there is no revenue leakage to the government. So that means it always tries to protect the revenue that has to be generated or earned by the government in the country. So with the arrangement where there is interdependence between the activities that are done by the registered branch and the parent office, if there is that interdependence, it means the revenue that is earned by the parent company, the offshore revenue, could have been earned by the registered branch and the requisite income taxes paid in the country. But with that kind of arrangement, you find that that revenue is somehow lost. That was the essence of introducing the provision of Section 92, subsection 5. Now, those provisions, specifically in terms of interpretation, has been cemented by the Court of Appeal in April number 35 of 2024 between Thales LAS France and the Commissioner General. So they are also having the same sort of arrangement that the registered branch, which was doing a portion of the contract, and that the parent office, which was also doing a portion of the contract. But TRA review of the activities that are done by the registered branch and the parent office, they come to realize that there is a huge degree of interdependence, meaning the activities are almost similar or the same. So that to reallocate the offshore revenue that was earned by the Thales France parent office to Tanzanian registered branch and collect the requisite income tax. So here is very important for registered branch that have parent office, which in some way they are both executing a certain contract in the country. So it is very imperative for them to revisit their activities, to revisit whatever engagement that they're having, and to see whether those activities can trigger what we call force of attraction. That is the allocation of offshore revenue to registered branch in the country. Okay, so the other interesting aspect is what we call transfer pricing dispute. So for the past 5 years, there is no area that the Revenue Authority has been investing strongly, like the International Tax Unit Department. That is a department responsible for transfer pricing, audits, and compliance review. So the essence is the government noted that a lot of revenue is lost in terms of the transfer pricing arrangement, as you find that most of the related parts players are not being audited to verify whether the arm's prices that they're actually saying they're at arm's are actually complying with the requirements of the local regulations. And also, you have to appreciate that most of the transfer pricing disputes are factual-based dispute, meaning their determination will normally hinge on the provision of documentary evidence, but also will involve a certain degree of subjectivity. So that's why we normally say that transfer pricing disputes are very tricky dispute, because you need to have strong and comprehensive documentary evidence, but on top of that, you also have to appreciate that it is an avenue that normally involves a degree of subjectivity. So now, the other biggest challenge that it has been observed with regards to transfer pricing, especially with multinational enterprises, is they normally find that they don't want maybe to engage local persons to prepare specified transfer pricing documentation for the specific country. So they normally take whatever TP document that has been prepared in another foreign country, and then just edit the relevant part to align with their local operations. And the rationale has always been that since transfer pricing documentation is normally guided by the OECD, so the expectation is whatever it is that has been reported in their foreign countries will likely pass, or will likely qualify in our local country. So now the recent ruling that has been done in Amadeus Global Travel Distribution vis-a-vis Commissioner General in AP number 200/7/2025, it has clearly now specified that in the context of transfer pricing dispute, the local regulations triumph over the OECD guidelines. So the OECD guidelines are more of persuasive interpretative tools. So for those taxpayers who just normally take the TP documents of their counterpart in the other country and just edit to align it to their local transaction, please note that with this decision, it is now clear that the local regulations take precedence or triumph over OECD guidelines, especially when there are inconsistencies. So it is very imperative to ensure that the transfer pricing documentation you are preparing not only comply with the OECD guidelines, but also comply with the local regulations. Yeah, I think the other notable issue that we believe we should be discussing is on excise duty chargeability, specifically on Tier 2 microfinance institutions. So we all know that in accordance to the dictates of the Excise Act, that is management and tariff, excise duty at the rate of 10% was introduced on charges or fees payable by a person to a financial institution. But the real challenge was the Excise Act did not provide a technical interpretation of what is a financial institution. So now you see there was a divisive school of thoughts, because there was those who were pulling for non-deposit taking microfinance institutions should not qualify as financial institution for excise duty purposes, while TRA was of the view that even the Tier 2 microfinance institutions, that is non-deposit taking microfinance institution, qualify as financial institution for excise duty purposes. Now, the recent ruling that was pronounced by the Court of Appeal in Appeal number 203 of 2025 between Commissioner General and Black Tanzania Finance Limited, then ruled that even Tier 2 microfinance institution qualify as financial institution for excise duty purposes. Why? This was because since there was no technical interpretation of the term financial institution in the Excise Act, the court then went and borrowed a technical interpretation of the financial institution from the other tax laws, specifically Income Tax Act. So now, by the mere decision of the court, it now means even non-deposit taking microfinance institution, that is the 2 microfinance institution, qualify for excise duty imposition because they are deemed or they are considered as financial institution. But this is only relevant for the period before July 2025. Why? Because the Finance Act 2025 introduced the technical interpretation of the term financial institution in the Excise Act. And in that interpretation, the Tier 2 microfinance institution, that is non-deposit taking institutions, were not included. So it means from July 2025 onwards, Tier 2 microfinance institutions do not qualify for excise duty chargeability. While for the period before July 2025, non-deposit taking microfinance institution may qualify for excise duty regime by the mere authority established by the Court of Appeal. So for the microfinance institution, for the guy in the microfinance institution, it might be imperative to analyze these two periods between July 2025 afterwards and before to see what is the potential exposure that might likely have in terms of excise duty imposition. Yeah, I think the other critical decision that is very important for taxpayers to know is there is a tendency where a taxpayer, for instance, when they're objecting an imputed assessment, they normally say not deliver certain documentary evidence on the assertion that they had provided that evidence in the audit stage. And then they just want to, let's say, reproduce that document, let's say when they're responding to a proposal for, let's say, intention to determine the objection. And then when TRA rejects to consider that documentary evidence or that evidence that they're actually providing at that time, they normally feel like it's unfair treatment. So okay. Yeah, so I was saying you'll find that they don't use documentary evidence during objection on the rationale on the assertion that such evidence was shared during audit stage. So the Court of Appeal has made it abundantly clear that the commencement of a tax dispute starts with an objection process. So for you to rely on wherever documentary evidence in that tax dispute, you have to adduce that documentary evidence during objection stage. Meaning, even though you had shared that documentary evidence during audit, since in the eyes of the law, tax dispute only commences when an objection process is start, you also have to reproduce that documentary evidence again, because failure to do that, if you go and delete the Tax Revenues Appeals Board rules, it clearly states you can only rely on the evidence that was provided during objection stage, meaning that if you do not use documentary evidence during objection stage, you cannot rely on that evidence when you prefer an appeal to Tax Revenue Appeals Board. So it might seem a bit unfair that you had already shared that information in an audit stage, but you find later on that since you did not reproduce that information during objection stage, you cannot rely on it. But now the Court of Appeal has made it very clear that that is because the commencement of a tax dispute is with objection process. So for those who are objecting against any assessment or any imputed assessment, please make sure that you provide all relevant documentary evidence to substantiate your case. And also, you should strongly note that documentary evidence or using documentary evidence is an art, meaning it's something that not everyone can do. So you need also the assistance of experts to guide you in terms of, let's say, this dispute. What documentary evidence will likely be relevant for you to be able to solve that issue? Yeah. Now, I think there are some few very cases which are more on procedural issues. So, for instance, there was a ruling by the Court of Appeal in terms of appealability to the Court of Appeal. So, for the past year and even for this quarter, we have observed that taxpayers still prefers factual-based dispute to the Court of Appeal. If you now go and read Section 26, subsection 2 of the Tax Revenues Appeals Act, Court of Appeal is only tasked to entertain dispute that emanate from questions of law. That is, they only interpret dispute that involve technical interpretation of the provisions of the law, not factual-based dispute. But for some time now, we have seen taxpayers trying to push factual-based case to the Court of Appeal. So this has been the precedent that has been repeated, or it has been an authority that has been established in a number of cases, not only this quarter, but even last year. But now, as we are on this topic, it is also very imperative to understand that as far as it is a factual dispute, that means after the objection stage, you only have the Tax Revenue Appeals Board and Tax Revenues Appeals Tribunal to entertain that matter. Meaning, once Tax Revenues Appeal Tribunal deliberate on that factual-based dispute, then that is like a final decision. So it means for factual-based dispute, it is very important to get them right from the get-go. That is to ensure the strategy that you are using, the strategy that you are adopting from the initial point of dispute, that is during an objection stage, is a right strategy, because once that decision is made, or once that dispute is deliberated by the Tax Revenues Appeals Tribunal, then that is treated as like a final decision, because you cannot challenge it anywhere. So it is very imperative for factual-based dispute to ensure you get them right from the start. And as I've said, most of the factual-based dispute, their deliberation is contingent on the provision of documentary evidence. And as I've said, using documentary evidence is an art. So you need to sit down with the expert, the tax consultant, to take you through in terms of whatever dispute that you're having, what will be the credible, what will be the accurate documentary evidence that we might need to ensure that you resolve those disputes accordingly. Yeah, and I think the other one was on a valid appeal decision, where the court just mentioned the significance of Tax Revenues Appeal Tribunal assigning reasons for the conclusion that they reach in a case. Similar to assessment, whenever you receive an assessment from the Tax Revenue Authority that does not indicate reasons or does not indicate the basis of that assessment, is normally deemed as what we call null and void. That is not as an assessment per se. So even in the aspect of tax decision, it is very imperative for the appellate machinery, that is Tax Revenue Appeals Board, Tax Revenues Appeals Tribunal, even the Court of Appeal, to assign reasons for the conclusion that they are reaching. That is, in another words, to make some sort of analysis in terms of the ground of the appeals that were preferred by the appellant, or yes, by the appellant, and even to address maybe the respondent response to the grounds of the appeal that were preferred by the appellant. So in this case, which was Commissioner General vis-a-vis Softtex Consultant Limited, appeal number 152 of 2025. So the Tax Revenues Appeals Tribunal did not assign reasons or did not analyze the ground of the appeal that were preferred by the taxpayer. They just went and indicated a conclusion that this matter is allowed or this matter is not allowed, without stating the reasons or the without assigning specific findings on why they're having a certain conclusion that they're having. So now with this ruling, it is like a reminder to the appellate machinery to ensure they analyze the ground of appeal that are preferred by the appellant and to assign reasons for the conclusion. But on top of that, this is also a reminder to you taxpayer that even for you, when you receive an assessment that does not indicate basis or does not indicate the reasons on why you are being assessed that amount, then you have to object, because in the eyes of the law, that is considered as null and void. Yeah, so I think that was all in terms of tax decision that were made recently. That is from January to March 2026. So before proceeding, maybe I allow for some questions. Beth, please take us through how you want us to handle that part. Yeah, so as we are waiting for Betha to give us some sort of
I'm back. I'm back, Kombaha. Thank
maybe
you
can
very much.
also go through some questions that have been posted in the... Okay, so please give us the directive.
All right. Thank you very much, Kombaha, for that wonderful presentation. It has significantly highlighted the areas that requires our attention, and I picked some items from the conversation or presentation, specifically on how aggressive our tax authority is right now in terms of collection of revenue, as well as the importance of not taking for granted or the auditing processes. As once you are audited and issued with assessment, more likely you can and then you go to the objection. If you didn't present the document that you presented during the objection, you're most likely to lose. And from the tax appeal that you have itemized, it indicates that majority of them are the taxpayers are on the losing side. And for that, I will invite, as you said, I'll invite the questions from the audience, but I see that there are some questions from the chat box. And one of them is from Amir. Okay, there is one from Marina who is talking about BAFIA Act. And she's asking about what about BAFIA Act? I guess the Act has provided the definition of financial institutions. Would you like to take one after the other, or should I read them all and then you respond?
I will take one after the other. So with respect to that, I think if you go to review the Black ruling, then you'll see that the Court of Appeal made a very clear argument in terms of why they prefer, or why where there is no technical interpretation of a certain term in a certain tax law, then the next step or the next place for court to borrow a leaf in terms of that interpretation is from the same tax laws or from other tax laws, not regulatory laws. Meaning, since the Excise Act did not provide a technical interpretation of the term financial institution, then the court held that the next step in terms of trying to figure what is a financial institution is to try and check other tax laws providing for that technical interpretation, not going to regulatory laws. That's why you see they did not make a very much emphasis on the Banking and Finance Act, because that is a purely regulatory law, or even the Microfinance Institution Act, because that is purely regulatory law. So they said, and that is like some sort of authority. So whenever there is no technical interpretation of a certain term in a given tax law, then the next step is to try and check whether other tax laws have provided for that technical interpretation. If not, then at that stage, you can then go and try to check with the regulatory laws, but you cannot go and try to borrow a leaf from the technical interpretation as provided by the regulatory laws before checking other tax laws. So that was the essence of not relying the technical interpretation provided under the Banking and Finance Act.
Thank you very much, Komba. I believe your address addresses the question from Marina. And then we have another question from Amir Hamis, and he's more concerned about the decision in the case of Commissioner General of TRA against BRAC Tanzania. And he's painting his opinion, and he wants you to comment on that opinion. And I will just read as it is on the chat box. It says, I consider this as a bad precedent for the following reasons. The imposition of tax liability to BRAC as a Tier 2 microfinance institution was not based on the tax statutes. The Act doesn't define the financial institution. The also to aspiration from the other statutes such as banking and financial institution and the BOT Act. However, BRAC falls under Tier 2 microfinance institutions, which, according to Section 5 of Microfinance Act, are not regulated by the Banking and Financial Institutions Act. The second reason is the President undermined the intention of the establishment of the Microfinance Act of 2018, which aimed at facilitating small-scale financial institution providers, financial service providers, not highly tied up with restrictive financial physical statutes. And he will want you to comment on his reasoning of seeing this precedent as a bad precedent.
Yeah, so in the tax arena, we normally have this saying, whether it's bad, whether it's good, as long as it's a precedent, it's a precedent. Unless it is changed, you have no other avenue than to follow it. So if we are to sit here and list a number of authority that were determined by the Court of Appeal, which we believe were bad, we could stay here all day, but there is no other option because that is the apex court of the country. So unless there is a distinguished ruling on the same issue, then we have no other option than to follow what has been decided, regardless of the sort process of the court. But it is the precedent, it is already there. So it's either we continue to challenge it, that is other microfinance institutions, especially for the period before July 2025, continue to challenge that decision until the Court of Appeal reverses or departs from its previous precedent, or otherwise we just have to follow it. There is no any other option.
Wonderful. Okay, another question is from Gloria. Glory, and the Glory, she's saying, please share your thought as to why TRI rejects information shared at the objections page, claiming information should be provided during the audit. And they quote the section 53 sub 6 of the Tax Administration Act.
Yeah, so the rationale is, you see, so the TRA department responsible for objection, their main job is to review whether the auditors made an accurate assessment. That is, wherever assessment that auditors issued to you as a taxpayer, was it inaccurate? So for them to do that, that means they also have to check whatever information that you had previously shared to them. So for instance, let's say there is Exhibit AB, which you never shared with the auditors, but now you are sharing with the objectors. That means you are giving the objectors a new job. That is, you are trying to turn them into auditors. So that's the essence of that rationale which they are saying. Similarly to when you go to TRAP, they'll just tell you that we can only rely on the evidence that you provided during objection. Unless if you want to provide a new evidence, you have to make a prayer, which is normally done 3 days before the commencement of the hearing of the appeal. So the essence is, in the TRA perspective, and in the way the Tax Administration Act has been drafted, objection is a mere review of the process that was done by the auditors. That is, those personnel who are handling objection are just coming to check whether, when you are saying that the assessment that was raised or was construed by the auditors is excessive, is that correct? So for that to be correct, or for them to do that job effectively, it means they have to go through whatever information that the auditor had. Because now if you give them information that you never gave to auditors, then it doesn't make sense for them to say that, you know what, the auditors, they issued an excessive assessment. Why? Because they never had that information which you are providing to them at that objection stage. So that is the rationale of them saying that, and also quoting those provisions of the Tax Administration Act. I don't know, Glory, if I've responded comprehensively to your question.
I believe you've done that, and for further conversation, of course, we are leaving our contact information on the chat box. They can always reach out, and we can explore more on this conversation. I'll move to another question, which is from Paul. Pom Kai seems like a startups founder because he's asking about what is the easiest way to get follow-ups about the laws related to taxes, especially if you are a startup. I think that is more of like a information question.
Yeah. So there are 2 or 3 ways. One, you can do it yourself. That is, you can be making follow-ups with, let's say, the tax laws or the areas where the tax laws are normally published. The other option is you can be making follow-ups with the newsletter that are normally issued by the tax consulting firms, even ourselves. We normally issue those newsletters. So through those newsletters, you can then know that there are these amendments that are coming through. But the other option, in case it might not be that expensive for startup, you can employ or you can engage a credible tax consultant whose responsibility, among others, will be to explain to you or to update you in terms of the amendment of tax or tax updates that are happening. So you just measure yourself between these 3 options, what works for you.
Wonderful. Another question is from Sule Hager. Sule Hager is making reference to the Court of Appeal decision in the Amadeus Global Travel. I see that you're smiling. It means that you know so very much about this decision. And it's a he, I believe, saying that the court held that the OECD transfer pricing guidelines are mere persuasive interpretative aids under the Regulation 9 sub 2 of the Income Tax Transfer Pricing Regulation of 2014 and not the binding statutory law. Given that Tanzania transfer pricing framework is largely modeled on and reference to those very guidelines, does this really create a dangerous gap where the TRA and tax tribunals can selectively apply whichever version of the OECD guidelines favors the Revenue Authority? This is very wonderful question, actually.
Yeah, I think to respond to that, we have to appreciate first the nature of what we call discretionary powers. So you see, when someone is given what we call discretionary powers, if that person is not honest enough, lack integrity, then a degree of a chance of that person abusing that power is very big. Why? Because they are discretionary powers. So no one will come and ask him or her, why are you making a certain decision? So if you go and read the way the Court of Appeal has enunciated in the case of Amadeus Global, they have clearly stated that OSD are a persuasive interpretative tool, meaning they are at the discretion of the appellate machinery and the Revenue Authority to adopt them and assist with the interpretation in the transfer pricing dispute. So since it is a discretionary powers, then there is that degree, or there is a risk that somehow a person might abuse that power to the tune that they interpret the transfer pricing dispute to the extent that they favor the Revenue Authority. But since we are operating on the assumption that the Revenue Authority and the appellate machinery are fair, so we don't expect them to abuse that discretionary power. So the expectation is we don't expect it to be a dangerous precedent. But also to avoid that risk, in the transfer pricing, we have what we call advance price agreement, EPA. That is, prior to having any transaction with your related party, you can go to the Revenue Authority and they agree on the arm's length price between you and the Revenue Authority. Meaning, once you agree on that price and you go and actuate it, then there is no any future dispute that is going to happen in terms of the transfer pricing. But for some reason, the advanced pricing arrangement or agreement are still not that popular in the country. There are some challenges around that. That is a discussion for another day. But in another developed countries, that is a tool that most taxpayers are using to avoid or to prevent unnecessary transfer pricing disputes.
All right, thank you very much, Benedict, for that comprehensive response in the persuasive and the discretionary powers of the judges. I'll ask you all the participants to try to mute their mic while they speak.
Yeah, so maybe Betha, there are two questions here. I can respond to this and then we proceed because I see time is not on our end. Maybe you read the two questions and then I respond and we move to other topics.
Yes, another question. I still see there is a question, additional question from Marina in relation to digital taxation, and she's asking, is there still a legal gap in digital taxation in Tanzania, and if yes, what it is?
Come again?
Is there a legal gap in digital taxation in Tanzania, and if yes, what it is?
I will not call it a legal gap per se. You see, digital taxation was introduced effectively, I think, in 2022, where the provisions for taxing non-resident electronic service providers were introduced. So up to now, you can see we are only at year 4 of having that. So it's still a learning process. The Revenue Authority is still learning in terms of how to effectively monitor compliance and also to identify those who are eligible for that digital taxation regime and how strongly they can enforce. So there is no legal gap per se, but there is that learning process because it's a new thing. So as time goes on, I think there are more and more improvement that will be coming. For instance, when the digital taxation started, it had mostly targeted the non-resident service electronic providers. But now, let's say for last year, I think, and this year, we have seen they have even started targeting digital assets like Bitcoin. We have also seen that they have started targeting like Airbnb owners. So we are moving, but we are moving slowly because it's a new thing. So I believe within the next few years, there might be a lot of improvement in the context of digital taxation.
Wonderful. It is indeed an evolving practice area or taxation area. So we hope that we will evolve with it. Another question is from Efania Mosh. First, she congratulates you for good presentation. So you received
Thank you.
And then she's asking that she would like to hear your comment how possible TRI can enforce DST compliance to non-resident service providers, taking into consideration that the mismatch between DST framework and the traditional role of the physical establishment.
Yeah, so TRA has already started enforcing because you see, for whatever payment you are making that is going outside the country, that information stays with the Central Bank of Tanzania. So TRA now, through the collaboration with the BOT, they can easily view, for instance, if you are talking about Netflix, how many payments were done, let's say last year, and what was the figure. Then they come and compare in terms of the declaration that Netflix has done via the returns that they submitted to the Revenue Authority. And just for the information, as of last year, TRA has already started auditing these non-resident electronic service provider in the context of DST and VAT regime. So the enforcement is there, but the challenge is TRA does not have that much strong power because it mostly comes to the willingness of the non-resident electronic service provider. Because as you are saying, the person is not here in the country. So the only option or the only enforcement avenue that TRA might likely have is to close the payment mechanism from the country to that person, which now, depending on the willingness and the contribution of the Tanzania business to that non-resident electronic service providers global business, it might be a bit challenging. But in terms of enforcement, the Revenue Authority is already doing that. As I've said, they are doing a number of tax audit on the DST and VAT registries.
Thank you very much for that response. I believe it has addressed the concern. And then we move to another question, which is from Teresia Sostenes, and she's speaking of the real-time issue that she has with perhaps the organization or some a colleague's organization. And she says that it is about the charitable organization which was conducting some transactions that required tax compliance, but they were paying the tax accordingly, but they were for a long period, almost a year, they found that they were not paying. They were paying anything because they were not submitting payment documents for TRA to verify. Now the problem is that they are liable to pay penalty. How to help them? So the question is that the payments were being made, but no submission of documentation. So the TRA comes and then they are liable to pay the penalty. So how can you help them navigate this issue?
Yeah, so I think this is a very specific question, and looking at the time that we have, it might take longer than that. So I think my answer to Teresia would be just reach out to us offline, and we'll have a very good discussion and take you through in terms of how best you can solve that situation.
Wonderful. Last question is about the withholding tax on retained earning, and it's from David Moshi, and he's asking about okay, is there any update on what withholding tax on retained earning? Want to know the applicability.
So to respond on that, you might see like TRA are quiet, but they are not quiet. The problem or the issue is, if you read the law, the commissioner can only deem after 12 months after the year end. So now, since this amendment was introduced last year, then that means it started on July 2025. And if now you are to count from that year, that means the first year end was on December 2025. So 12 months from December 2025 means it was almost up to December 2026, almost to November 2026. So meaning from November 2026 this year, then we might start seeing the commissioner actuating on the deemed retained earnings distribution. But right now, you don't see anything. Why? Because as per the requirement of the law, the commissioner can only do that 12 months after the year end. And since the amendment came in July 2025, that means the initial year end was on December 2025. So the 12 months from there, that means will only lapse November 2026. That is November this year. So from November this year, we will likely start seeing the commissioner exercising those discretionary powers on that aspect. So in terms of exemptions and what are the conditions for that, so the only entity that have been excluded for these provisions are those with non-resident shareholders, because in the eyes of the TRA, they are already deeming them as what we call controlled foreign corporation, meaning they are already deemed as distributed their unallocated income under the previous existing provision of the Income Tax Act, even though the deeming CFC provisions are still challenged at the Court of Appeal right now, because the taxpayer had initially appealed before the board, where the board had ruled in favor of the TRA. It was then appealed before tribunal, where the tribunal had ruled in favor of the taxpayer. So now the TRA had appealed to the Court of Appeal. So we are still waiting for the Court of Appeal decision on that. But in terms of exemption, at the moment, in terms of the way the law has been drafted, only resident entities with non-resident shareholders are the ones that are excluded, not exempted, excluded from the Commissioner General discretionary powers of deeming the undistributed retained earnings as distributed.
Komba, continue. Oh, you're done.
Yeah. So
Okay. So I
Yes.
just wanted for us to put a little bit of pause to the question and I'll cycle back, but we go back to the presentation because we still have
Yeah.
very few minutes.
Maybe a special favor. I've seen a very good friend of mine has posted a question. So as a special favor to him, I will respond to that. That is Sunday Okello. So I think he's asking what is the rationale for TRA to require that non-resident service provider to register for TIN. So very straightforward, Sunday. The essence or the rationale for that is to curb what we call tax evasion. So you see, in the past, most people, what they will do, they will just, for the sake of passing certain expenses in their books, they just indicate that, let's say I'm purchasing service 123 from a certain company in Mauritius. They will pay 15% on that, and then they'll put that expense there. And if you come and want to audit and request for documentary evidence, they'll just print you an invoice, because you see, an invoice from a foreigner does not need to have fiscal receipts as the local invoices. So now for TRA to curb that, they want to ensure that all non-resident service providers are registered with TINs, meaning they can now easily check and confirm where are you actually procuring those services, and if you are actually procuring them, and at what rate are you actually procuring those services. Because uh, you cannot deploy a team of an resident service provider and indicate you have incurred or you have secured a service from that non-service provider, why that is not what had actually happened. So it's a more of tax evasion control mechanism. Yeah. So maybe we can go quickly on the last part of the presentation. That is, what are the amendments that are likely being operationalized in 2026? So the first one is the 2% income tax on forest produce. So the government had imposed what we call a single installment tax on forest produce, on the sale of forest produce by a person other than a corporation. So if you are an individual and you are selling forest produce, be timber, be logs, be poles, after you have sold that, you need to pay 2% on the income that you have earned. And why? And when this tax has to be paid before the transportation of that produce, meaning by the time the produce is being transported, uh, you need to have a certificate that proves you have actually paid that 2% income tax on that produce. So this amendment is going to be operationalized in January 2026. So it is already in action now. The other amendment that is going to come through this year is what we call cessation of VAT deferment on imported capital goods. So previously, the law had allowed for what we call application to defer VAT payments on imported capital goods. So when you are importing capital goods, you could apply for deferment contingent on meeting certain criteria. But now the law was amended so that from 30th June 2026, you can only apply for VAT deferment on locally manufactured goods. So this amendment was initially imposed for the mere fact of protecting and boosting our local industry. The other amendments that are coming through this year are cessation of zero rating on locally manufactured cotton grounds from locally grown cotton. We don't know. Maybe the Finance Act might extend for another year, but at the moment, comes June 2026, that is the rating is going to cease. And the other is cessation of VAT exemption on edible oil produced from the locally grown seeds and air charter services. And the other one that has been in operation from January 2026 is what we call mandatory insurance travel fee for foreigners, which is $44. This excludes those coming from East Africa community and Southern Africa Development Community, SADC. Yeah, and since we only have 7 minutes till the lapse of our webinar time, so allow me to take you quickly in terms of the basing tax issues that we have observed for the period of January to March 2026. So one, we have seen a surge in TP audits. We have seen TRA now doing several TP audits. So for taxpayers who are having related party transactions, it might be pertinent for you to prepare yourself against or to expect a TP audit within any time from now on. And then there is a concept that is gaining traction very quickly, what we call a representative assessee concept. So this is where we say representative assessee is defined in the Income Tax Act to mean an agent of an unresident person, where an agent of an unresident person is interpreted to mean someone who is employed by an unresident person, someone who has a business connection with an unresident person, or someone through whom an unresident person earns income in the country. So for those who have a certain engagement with non-resident or those who have been employed by non-resident, it might be pertinent for them to revisit their operation to confirm whether they qualify as representative assessee and to see how best they can mitigate that exposure. And the other ones, these are the normal ones. They are the recurring issues like the input VAT credit claims. So you see, as the input tax in the IDRAS is pre-populated, so most taxpayers, they normally don't spend time to check whether all the pre-populated VAT on purchases qualify for input tax. So they just accept whatever it is that they find. And then when TRA comes and audits them, they find that there are some certain purchases that were there, but they are not qualifying for input tax. So it might be also pertinent to review the pre-populated purchases and confirm whether all of that VAT that is depicted there qualify for input tax credit. And the other one is the normal one, which is cash reconciliation test, where the TRA just try to check the accuracy of the revenue that you are reporting, whether you are actually reporting the accurate revenue. So they normally compare whatever credit they find in your bank statement vis-a-vis whatever it is that you are declaring in your financial statement. And the other one is deductibility of expenses, the essence of having credible and relevant documentary evidence. You find that you have an expense, but when TRA asks you that please provide documentary evidence for us to ascertain deductibility of this expense, most taxpayers they normally fail. So it is very imperative to also analyze and see, like in terms of your transaction, especially those major transactions, do you really have comprehensive and sufficient documentary evidence to sustain or to substantiate the deductibility of that expense? So, Beth, I think that will be all from my end. Over to you.
Thank you very much, Komba, for that wonderful presentation. It's been an insightful discussion, and I believe we are headed to the end of our discussion today. And there were a couple of questions that were remaining, but okay. So it's just maybe two questions. Okay, maybe we can try to attempt these two questions, but I wanted also to ensure our audience that the questions that have been painted on the chat box, we will be having this conversation. It's a beginning of the series of the conversation, so stay close to our newsletter, stay close to our social medias, because we have presence on the website, we have presence on the LinkedIn, Instagram, Twitter, and the rest. So as much as we want to address all the questions, we are running out of time, but we'll continue this conversation. And thus, I will have to end this session. But before I end, unless there is someone who is really want to speak before I end the conversation. Is there someone who want to come through? Not necessarily on the questioning, but comments, contribution, anyone, you can raise your hand, I can see you. Okay. I don't see anyone, unless Benedict, if you see anyone on your end. Okay. So there is no one, and there are two questions remaining, and our coordinating team are telling me that we'll take this question and we will possibly address them in writing, and we'll be publishing on our newsletter. So stay close to our newsletter, stay close to our social media platforms. And with that, I would like to thank very much, everyone, for your time and engagement this afternoon. It's been an insightful session, and I hope, it's my big hope, that you've not been taken through like an oversight or insight or overview only, but you've been given an insight, valuable insight that will be helping you in addressing your practical challenges that you have on your business, on your professional development, on your startup, and wherever that you are operating from. And as we believe that the landscape of tax is continually evolving, either through the court decisions or regulatory shifts and emerging areas such as digital taxation and the likes. And it's very, very important to stay informed, proactive, and well advised. So we continue to encourage you guys to seek advice from the expert, and we are here to support you anytime. And like I said, you stay close to our social media platform, because we're very active on publication. So we'll be publishing regular insights about the taxes and other areas of legal practices. And on behalf of Victoria Attorneys, I would like to appreciate Benedict Kombaha, our tax and finance partner, for bringing through this conversation and the practical perspective that you've shared with our audience today, and for taking time to share with the audience today. Thank you very much. And this marked the beginning of the long journey, and we hope that the audience will stay with us. Benedict Kombaha, before I say goodbye, do you have a parting word? If you have, please come through.
Just a thank you to our audience. That's all.
All right, thank you very much. And this marks the end of our session, but be reminded of staying close to our social media, and just know that we'll be having this series. It's the beginning of our regular series, so we will publish on when we'll have next series. It will be on the tax and finance and the other areas of legal practices. So I believe that we are in this journey together, and for that, I thank you each and everyone, and have a good evening.
Mm.